Let's call this segment The Revenge of the Permabear. Then again, that is just a label I've received for many years. And that's because a whole lot of people conflate risk management, diversification, and capital preservation as sources of bearishness, whereas I see these characteristics as nothing more than prudent wealth building. But let's assume that the masses are right and that yours truly is a permabear. The question is, does the said permabear make you money? And the answer is yes. And the answer has always been yes. And there's proof. And that's partly because I never once in my professional life ever advocated a portfolio of canned tuna, baked beans, barbed wire, or sawed-off shotguns. Now, it was back in early 2023 when I finally said enough is enough, when I was constantly asked how I would grade my track record over the decades. It was never really a fair question, since not every forecast is exactly born equally. You know, there are big calls and then there are little calls. And my tagline reply all the time was that if I ever managed to make it to Cooperstown for economics, it would be for at-bats as opposed to batting average. But then I had a eureka moment nearly 3 years ago. Why not start a model portfolio seeded with my own money and put my money where my mouth is? Let's see in real time how Permabear David Rosenberg performs when he invests around his macro and market views. This whole process of holding my feet to the fire has actually helped me become an even more disciplined economist and strategist. Be disciplined at all times, never stubborn, don't hang on to a bad call longer than necessary, and be ready to take chips off the table and repel greed at all costs and at all times. And never fall in love with your forecast or your portfolio, because they don't always love you back. Better that we all fall in love with our partners instead. Now, with that last point in mind, the decisions on what goes into this Rosie Macro Fund boil down to my own personal views, the recommendations from Rosenberg Research's monthly strategizer model, and the firm's secular investment thematics. To keep the costs low, liquidity high, the holdings in this model or fund are all in various ETFs. And I would hazard to say that half the model is basically buy and hold insofar as it reflects our longer term views. Half is tactical to take advantage of any mispricing that we see in the capital markets that are worth exploiting. So this has been and remains, for the better part of the past 3 years, almost, a macro fund in the truest definition, because it incorporates our macro views and it covers all four corners of the marketplace that we delve into every single day: equities, bonds, currencies, and commodities. It's diversified globally, it's diversified across all the asset classes, but it is concentrated to the extent that this fund incorporates our highest conviction ideas. Now, this Rosie Macro Fund, and I've been talking about it for a while, is what I have always referred to as the classic widows and orphans or sleep at night portfolio. In baseball parlance, it's not intended to swing for the fences. It's aimed at bunting for singles, and we are happy with the odd double. No home runs perhaps, but no strikeouts. Capital preservation and the preservation of cash flows are the basic factors behind the strategy. So, let's examine what this all entails from a stochastic standpoint. Firstly, concentrate on a low beta to our benchmark, which is a 60-40 asset mix. The beta on the portfolio, 0.5. Anything below 1, fantastic, it's 0.5. A high Sharpe ratio. Anything above 1 is great, it's 1.4. And a decent running yield, which it has in the context of the interest rate and dividend environment that we're in. It's a running yield of 2.2%, which is basically about double what you will get in the S&P 500 dividend yield. So just to regroup, my team and I constructed this fund. Right now it's a model and went live with it in February 2023. We began to highlight it more in my daily musings early this year after a long enough incubation period to gauge its track record in absolute and relative terms. And the good news is that it's doing exactly what it should be doing: minimal capture in market drawdowns and upside capture in risk-on periods. Now let me give you a couple of examples as to what I'm talking about. You go back to the February-April tariff-induced sell-off earlier this year. This model outperformed the S&P 500 by more than 1,200 basis points. It outperformed the classic 60-40 stock bond allocation by almost 500 basis points. Then, since the manic move higher in the risk-on trade from the April lows, this fund or model has captured nearly 70% of the upside in equities. And again, the benchmark is really the 60-40 asset mix, and it's outperformed in that period by over 230 basis points. I'm also happy to report, and this is in absolute terms, that year to date, the fund run by the Permabear has generated a net positive return of nearly 24%. And it's up 45% since that inception date in early 2023. It is up 45%. So those numbers compare to 11% and 42% respectively for the classic 60-40 asset mix. So basically, it's doubled the performance this year of the 60-40 asset mix, but with far superior risk metrics. And I should probably add this, that when we backtested the initial makeup of this fund against what happened in that horrible 2022 year when inflation was raging and the Fed was tightening policy like it was nobody's business, that this fund did not participate in that equity market drawdown at the time, nor did it participate in the drawdown in the 60-40 asset mix at the time, because at that point bonds were also getting hurt. So I want to make this point emphatically again. This model or fund, it will become a fund. I'll get into that in a few minutes. But it's doing exactly what we built it to achieve. Low risk, low volatility, most of all, to reiterate, capital preservations. Once again, we bunt for singles, we hit the odd double, very rarely we'll hit a triple, but we never ever try to swing for the fences because striking out is not part of this mandate. Once again, it aims to capture upside in bull markets, minimize drawdowns in the rough times. It plays the band of market outcomes far tighter than what you will get through investing in most indices. So that's how it's constructed. It's why this is really the tried, tested, and true sleep at night portfolio. I should have introduced this in my work years ago, if not decades ago. But I'll say this much. If you want a lot of juice, you want junk, you want speculative assets and guesswork, or lady luck for that matter, this is definitely not for you. From a top-down perspective, well, as I mentioned, that the portfolio was concentrated amongst our highest conviction themes, it is very well diversified across the various sectors and asset classes. It's got 20% in bonds, 10% in cash, 15% in commodities. That jumps to 25% if we include our uranium exposure. It's got 5% Japanese yen exposure. We just made a recent asset mix shift and took some profits in gold and silver and the miners and moved it into critical minerals. And we also have exposure to Canadian pipelines, aerospace defense, and utilities. Very broad ranging and very well thought out and premised on our research. And it's diversified across asset classes, equity sectors, and geographies. So it's diversified in that sense, but concentrated amongst the highest conviction themes of all the research work that we do at my firm. Last but not least, we're in the process of turning this model portfolio into an actual listed ETF. And our target date is January 2026. At that time, you can always buy my research to help you in your investment decisions, as people have done for years, if not decades. But you're going to have the capacity starting at the beginning of next year to also invest right along with me in my thought process. And again, only for investors that don't like to lose money or take on risks that simply aren't worth the price. I don't invest in bubbles. I don't invest in two standard deviation events unless these events show mispricing in terms of undue undervaluation. And these days, those are needles in the haystack. So stay tuned. I'll be providing updates on the launch in coming weeks and months. And I hope you join me on this next exciting chapter of Rosenberg research, keeping in mind that so far this year, once again, this portfolio is up 24%. I have subscribers that have tried to mirror this ETF portfolio, and hopefully they have, because 24% is basically 1,000 basis point outperformance against the beloved S&P 500, and I managed to do that without owning one Mag 7 stock. So much for being a Permabear, don't you think?